You've probably heard the whispers, or maybe you've seen the headlines. The tax man's on the hunt, and property investors are squarely in their crosshairs. That's right, the Australian Taxation Office is ramping up its efforts to recoup an estimated $9 billion worth of revenue deficit, and they're pulling out all stops. What are they doing? Well, innovative strategies? Check. New alliances with asset managers and banks? Check. Advanced technologies to scrutinize investment loans and asset sales? Double check. So if you're an investor in property, this is your call to be vigilant and informed. But today I'm joined by Ken Race, Director of Metropole Wealth Advisory, who's here to guide you through the treacherous waters of this new tax landscape. Now, Ken's got a wealth of knowledge, and he's here to share his insights on how to navigate the ATO's watchlist without getting caught in the tax man's net. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
If you're a property investor, watch out. The tax man's after you. Well, you and all other property investors. This means Australian property investors should be on high alert as the Australian Taxation Office implements some new innovative strategies, and they've formed new alliances in a bid to recoup what they're suggesting is an estimated $9 billion revenue deficit. So to discuss how to avoid getting trapped by the tax man, I'm joined today by Ken Race, Director of Metropole Wealth Advisory and highly regarded as one of Australia's leading property tax strategists. Hi, Ken.
Hi, Michael.
Well, from what I've read, the tax man's going to be using advanced technologies. They're going to be sharing things with banks and other asset managers. They're looking for a number of different things, abuses of the system, unreported sales. It's also, I guess, now that we're working from home a lot more, looking at all those sort of deductions. So maybe we could go initially through some of the areas that you think the tax man's going to be looking at more carefully. And I know they've actually told us some of these to prevent us making mistakes. And again, we're not suggesting in any way that one should be avoiding tax. That's not the case at all. I guess what we're saying is be careful that you got all your I's dotted and your T's crossed.
That's right. I read a frightening stat just a couple of days ago. The IT budget, the information technology budget for the ATO is plus or minus $150 million a year.
Wow.
And they've been spending that for many, many years. So they're automating things now. They're doing data matching with the banks, with the state governments, with all the various people that can be involved in any income generating activity. So it's not that they've got an army of people, it's they've got smart at what they're doing. And IT now is leading the charge.
Well, I guess they've got their own versions of ChatGPT and all those things that you and I play with on a much smaller scale.
That's right.
So what are they looking for, Ken?
Well, the ATO, every year puts out, I'll use other people's colourful language, a hit list of things to look at. And the way they determine that list is from sample checking. So they'll do sample checkings on different aspects. And depending on, using your words, Michael, the number of mistakes that they find, they then put it on a list. And when they look at things that have got 60, 70, 80% errors from a particular category, that means they're going to scrutinize that. And it's the gig economy, it's property investors, it's working from home expenses, that they see that there is low-hanging fruit for them to pick off. And in the majority of cases, it's low-hanging because the taxpayer hasn't kept good records. They haven't asked the right questions of what can and can't be done and under what circumstances. So one of the big ones they're going to look at is capital gains tax scrutiny. And by that I mean the sale of an asset that generates a capital gain, there should be tax on there. So they're going to be looking at property sales. So they're now matching data with the various state governments. They're seeing the titles office changes. They're looking at cryptocurrency. So years ago, it was very difficult for the ATO to understand what was happening in that crypto space. But now most people are going through 2 or 3 different, can I say, platforms, and therefore they've gone to them. The Airbnbs, all those sorts of things, the rideshare people. So the ATO commissioner is emphasising the importance of correctly calculating your capital gains tax liabilities and to then pay the appropriate tax. So one of the first mistakes that people make is, what date is that capital gains tax triggered? If you sell a property or sell any other asset, it's from the date of exchange of contracts, not when you settle and get the money. So that puts a lot of people at a disadvantage, if you like, if they're selling at the end of a financial year, because depending on when they're doing their tax returns, they might have to pay the capital gains tax before they even get the funds from selling the asset. So be careful of that. And then the way you calculate capital gains tax is quite different. So if you've got a property, they talk about the cost base, so the cost of buying the property, the stamp duty, cost of renovations and improvements.
One of the things people don't recognise, Ken, a lot of investors don't recognise, is you've got to add back the depreciation that you've gained along the way. In other words, most of us understand the concept you've got to have a depreciation schedule because the value of the building depreciates over 40 years and the value of the assets within it, the carpets, the curtains, the air conditioners, depreciate quicker. But people forget to add back that. Doesn't seem fair, but I can understand why that happens.
Yeah, so ostensibly there's 2 components of depreciation. There's the fixtures and fittings and the building. So we've got to add back the building depreciation. That's why if you notice when you do your tax returns, you show that building depreciation as a separate line item, whereas the other depreciation is all added together with other expenses. And you make the point, Michael, about a lot of people actually don't claim depreciation because they say, well, I'm going to have to pay it back. But you claim it at your marginal tax rates, and then when you add it up back, you get the 50% capital gains tax discount.
I'd rather have the money this year than in 10 or 15 years' time if I ever do sell the property.
If you ever do sell.
But it's funny how some people think. I agree with you.
Yeah. So capital gains tax is a tax derived on a capital gain. It seems silly to say that, but we've got to look at, is the gain a capital gain or normal income? So if you buy an asset with the intention to resell, then it's not a capital gain. It's normal income, and you pay tax at your marginal tax rates. You don't get the 50% discount. If you bought it with the intention to keep and for a reason you have to sell, it's a capital gain. And if you've held it more than 12 months from exchange date to exchange date, then you get the 50% discount.
Now, we never advocate buying, renovating and flipping. We'd much rather keep the asset and refinance and do it again. But those people who are wanting to do that to get quick money, they don't get the benefit of the 50% capital gains tax exemption, even if it takes over a year.
So don't be worried if you've bought an asset to keep and you sell it in under 12 months, because it's still considered a capital gain, which you can offset against capital losses, because capital losses require capital gains to absorb them. The other big thing is in the cryptocurrency world. A lot of people now are doing what's called staking. So they're using their cryptocurrency to stake. And in some instances, you actually get a reward for that. And I use the word reward because that's the technical term. you may not actually get access to those monies. So you've got to be very careful in what income you're getting from your crypto. Is it income that you have to declare? Is it income that you have to just keep track of? Is it a capital gain? Is it normal income? That crypto is an area that is very misunderstood, for want of a better way to determine it or describe it, which is outside of the purview of a lot of the traditional day-to-day accountants.
Makes sense. Sure. The taxman's always been funny about trusts, while I know you have always recommended, for most people, to keep their assets in trusts, and that's what all our high net worth clients at Metropole Wealth Advisory do. The ATO is vigilant about complex ownership structures and family trusts not used in the right way, especially distributing money to kids, to minors who maybe don't even actually ever get the money.
Yeah, so as you said, the ATO has a lot of concerns about trusts. I think it's driven from one fact to start off with, and that is trust law is state law. It's the laws on how to use trusts and how to operate them are driven by states, and therefore each state is slightly different. And the ATO is trying to put this blanket umbrella to collect taxes. And there's different type of trusts. There are ones that give fixed entitlements. So it's like having a share in a company. You're entitled to your X% distribution. So some trusts are unit trusts where you have that fixed entitlement. Other trusts are what are called discretionary trusts, where the distribution can go to anybody and change from year to year, et cetera, et cetera. And it's in that latter one that the ATO is paying particular attention to make sure that they're being operated correctly, that the year-end accounts are set up. And, one of the quirks with legislation is by the 30th of June, you've got to do your distribution minutes. Now, how do we know what that trust has made before the 30th of June? But that was a High Court case that decided that, so there's no getting away from it. So even if you're doing things well and truly legal, you've got to make sure the I's are dotted and the T's crossed. You've got to be very careful if you're going to distribute money to minor children or to other family members where you're just going to take the benefit of the lower tax rate and then just ask them for the money back. So that's a big one the ATO is going to jump on and specifically deny that reduced tax rate because it's gone to someone at a lower tax rate than you.
Now, we should have started with this, and there's always a disclaimer at the end of the show. We should say that this is not specific advice for you. While Ken is an accountant and got financial planning qualifications and advises some very high net worth clients, as well as lots of ordinary Australians, this isn't advice for you because we don't know your personal circumstances. But of course, you can see Ken's depth of knowledge. And while he is an accountant, he doesn't want to do your accounting. But Ken, if people have got questions about trusts or any of these things, would you be happy for them to have a chat with you about them?
Oh, absolutely. Absolutely. So without being a sales pitch, you make an inquiry. It'll come through to me. We have what's called a suitability call, where I try and understand what your concerns and issues are to see whether we can help you and how we can help you. So at least put up your hand, metaphorically speaking, and make an inquiry.
Well, we've had a number of discussions about trusts before. This isn't the right time to talk about it, but one of the things I know that you do is actually make sure that the trust documentation is appropriate for today, because basically a trust is a document with clauses in it, and most of the trusts I've come across, and I don't come across it anywhere near as many as you, actually have a couple of very significant ones missing that I know that you and the team at Metropole Wealth Advisory always put in trusts. But let's get back to what the tax department's looking at. And over COVID, many of us, including you and me, who are both working from home today as we record this, many of us work from home for some of the time. I'm now doing it all the time. But I bet the tax department's looking at deductions a bit more carefully about this.
Yes, they made it relatively simple during COVID. They had a flat rate that you could claim on an hourly rate for the use of your consumables, your gas, your electricity, the water, your phone, your computer, those sorts of things. But now that we're out of COVID, that methodology of claiming deductions from home has been revised. And from July 2022, there's now two methods to calculate when you work from home. There is the fixed rate that the ATO has published, which is currently 67 cents an hour. And there's an actual cost method. So if you can actually show additional costs for you working from home, then keep a tab of that. But you've got to be very careful that you've got to be working from home to fulfill your employment duties. You can't just be doing the odd thing. Your employer has to have basically asked you to perform those functions, of which you have to do from home.
Ken, I just did a calculation, 67 cents an hour. If you work 40 hours a week from home, you can deduct $26.
Yeah, a week.
A week.
Nothing. Look, the cynic in me would say, people might choose that lower method, cents per hour, compared to having to put together big spreadsheets. But I think you've hit the nail right on the head. And if those hours are long, then I think you should go to the extent of keeping a log. And it's the same as for car expenses. People either have so many cents per kilometre or they keep a cost. So the big thing is you've got to incur those additional running expenses. So it can't be, I get an electricity bill and some of it must be. So did you have lights on in a dedicated area? If you've got zoned air conditioning, did you heat up the home more or cool it more? All those sorts of things. And I think for most people, it's going to be a decision they're going to have to make, whether they go to 67 cents per hour route or whether they keep the actual costs.
Okay, most people listening to this are interested in property. Most of them are property investors. What about property investment deductions? What's the tax man looking at there, Ken?
I think there's a couple of things that they're really looking at. It's if claiming repairs, that it is actually a repair as opposed to an improvement. So improvements would need to be depreciated over time. If you replaced a cupboard door in the kitchen, that's a repair. So if I give you an extreme, if you replace all the kitchen cupboards, that's probably an improvement. So they're really onto that. The other big thing, particularly when people are buying an investment property, is do they need to do some work on that property prior to the first tenant coming in? Even if it is classified as a repair, the ATO says no. You can't claim it immediately if you spent that money prior to that first tenant. Because the ATO argues you bought the place a bit cheaper because you knew you had to do those repairs. So they're really looking at repairs to make sure that you're not over-claiming what should be improvements.
Now, a lot of people get caught out in that, Ken, because they buy an old place and they renovate it and they do it up and they think, oh, fantastic, I can actually claim all this from day one. That's not the case.
That's not the case. So what could be a repair when you've got a tenant is actually classified as an improvement if you're doing that between tenants or before you get that first tenant when you buy.
Sure. What about holiday homes? I know they're looking at those a bit more carefully too.
Yeah. I think two things in that area. It's, can I say, renting out the spare room? Airbnb. You've got to show that as income. And yes, you've got some expenses associated with that, but it's income. And the big issue is if you're claiming part of your home as income producing, you lose part of the benefits under what they call the main residence exemption, which is normally when you sell your home, you pay no capital gains tax. But if you've been renting a room, renting it out at a market rate, then proportionately you would lose that as a free capital gains. And on the point you just made, Michael, on a holiday home, that property has to be available for rent. It's got to be actively, the agent...
Marketed, doesn't it?
Marketed. There's got to be an agency agreement. So if you're personally using it, then it's not available, and therefore those proportional expenses you can't claim anymore. So be very careful with holiday homes where the ATO would see that that property wasn't tenanted for the 52 weeks of the year, because that's a sure giveaway that what happened to the other periods.
So, Ken, we talked a bit about property investment. I know one of the things the taxman's always been wondering about and looking more carefully is the interest that we claim actually interest used in earning income? Is it a legitimate tax deduction or is it a personal expense?
That's right. And they come to what's called the purpose of the loan. So did you borrow that money for the purposes of investing to generate income, or was it for personal use?
Now, of course, it doesn't matter what you use as security for the loan. So you can use your home as security for the deposit for an investment. Then it's tax deductible. But it's really important to document it correctly. And that's why often people have split loans, separate loans. And it also has to do with whether you put money back into your offset account or repay your debt. Not time to discuss that today. But you and I have been spending a lot of time working on the updated edition of what every property investor needs to know about finance, tax and the law. And that book should be out in July, where we actually go into a lot of detail about some of the things you've already been discussing, but also about how to set up your finances right. But maybe we should just have a quick overview about interest deductions, Ken.
So two things. Are you using that loan for business purposes or investment income generating, or for personal? So if you've got a family home, and I'm giving that as an example, and you've got a loan on it, and you increase that loan so as to have you refinance, you get a bigger loan, that means you've mixed the home loan for your own personal use with the investment property. And it is, hell to actually do spreadsheets and are you paying down? You just can't.
In other words, you've tainted the loan. Now, you would think that bank officers would know this, but they don't. And you would think many mortgage brokers would know this. And again, there are some really great proficient finance strategists and mortgage brokers, and we work with a lot of them, but many of them actually don't do that because it sounds just too easy. Hey, your house has gone up in value. Let's just increase your home loan and use that as a deposit.
That's it. And, that's when you use the word a split loan. You should say, no, that new loan, the purpose is going to be for investment. So call that loan B, give me a separate statement. The interest will come out, no calculations. The other big thing is what people sometimes do is they've got a redraw facility. So they actually put their wages in or something like that to keep the interest repayments down, and then they pull it out again. Now, that again taints the loan because as you're reducing the loan, when you now pull the money out, it's what did you use it for? So you could destroy, if you like, the interest deductibility. The other big one to watch is if you've borrowed money under a different name than the ownership of the property. So some of our clients buy the property in the high taxpayer's name, but the loans could be in the two spouses' names. So the ATO queries, well, are you only entitled to half the loan deduction? So you've just got to be careful with that paperwork to make sure it's all done correctly and have your records up to date.
Now, people are probably listening to this and wondering, where do I even start? Well, I know that's one of the reasons that you do a property wealth check to actually assess people's current situation, not just their loans, but their structures and their super fund. So again, I'm sorry to give a plug for Ken's services, but I've seen him help so many people prevent them from stepping on landmines that if you're interested in getting Ken to have a chat with you, I'll leave a link in the show notes, but go to Metropole and the Wealth Advisory tab and let's see if Ken can give you some assistance. Now, I know a lot of our clients and people listening to this are also keen to get involved in property development and renovations. That's on the hit list, let's call it, of the tax department this year.
Yeah, because that can fall in one of two camps. I'm doing a development for resale. If that's the case, then you've got to register for GST. You've got to treat it as a business. It's now business income, and the profits are taxed at marginal tax rates. And that would be, if it's a company, the company tax rates, or if it's individuals, then it's at their marginal tax rates, or if it's a trust, the same again. So you've got to distinguish a development for resale versus a development that you're going to keep, because if it's you're going to keep it, you don't have to register for GST, you can't claim the input tax credits. So the difficulty comes is if you do a development with mixed intentions. I'm going to build 3, keep 2 and sell 1. So that then has its complications that can be managed. So the one you sell is treated differently to the 2 you're going to keep. And it's a discussion I have with a lot of clients. You've got to have the right structure.
Well, Ken, if we could interrupt for a sec, this is also to do with when a lot of people do developments with their brothers, their sisters, a friend, and you and I will go and buy a property together and I'll keep unit 1 and you keep unit 2. It's not as simple as that because we both own the completed project and then I've got to buy half off you and pay stamp duty and you've got to pay capital gains tax in reverse. But I know that because a lot of people have got this requirement, you've got some legal ways of minimising the tax and the stamp duty exposure.
That's correct. So if you're doing it, can I use the word a joint venture with a family member or a friend? At the end of the day, in a simple example, you've built 2. One wants the left, one wants the right. But when you split them, there's tax, there's GST, there's stamp duty. So there are legal ways with the correct documentation to allow that split to occur at completion without triggering those taxes that even on $1 million value property at the end can be worth up to $200,000 in taxes, which are totally avoidable.
Well, I know you've actually helped a few of my kids, 2 of my kids have done, or 3 of my kids have done joint venture developments with their siblings, and it's made a big, big difference having it all set up. But the answer is you've got to set it up even before you start.
You've got to set it up before you start. This is something you can't do retrospectively because you've signed the contract and it's the way you sign the contract that dictates what happens afterwards, as well as having the documentation.
So anyone who's interested in doing property development with a friend, a colleague, a family member, see Ken beforehand. Now, we keep saying see Ken. You'd think the average accountant would know this or the solicitor would know this, but it's not in their everyday workflow, is it?
No, because we're talking of a mixture of different professional inputs. There's the tax, there's the accounting, but even within that, there is the run-of-the-mill stuff and there's the higher-end stuff. And most local accountants, if I was to describe them, don't know the 20%, which is the higher level. The other thing is there's law involved in
They
this.
don't need you for 99% of their clients.
Correct.
But if you're that client and you need it.
That's when you've missed out. If they don't do it all the time, if they're not having these discussions with the various lawyers of what's happens, what's changed. I mean, every time there's a state budget or a federal government budget, things change. Or the various state or federal governments reinterpret the meaning of something. And what could be done last year, they say is no longer applicable this year. So you've got to keep up to date with all those changes, but more importantly, what is possible legally.
That's important, doing it correctly and legally. Okay, there's a couple of other areas I'd like to look at with you, and one is overseas investments. First of all, a lot of Australians have initially come from overseas, or they've got family members from overseas, or they've inherited properties overseas, or they've bought properties overseas, the taxman is looking at these carefully.
Correct. So if it's property that you've bought in Australia and you move overseas, the government knows you've sold it because it goes through all the various title changes, etc., and then it's taxed in Australia. So it's called taxable Australian property. The issue then is with the overseas assets. So as an Australian tax resident, you're taxed on your worldwide income, and it is your responsibility to notify the ATO of income from any source, from any location.
Now, the taxman's not very friendly to expats, are they?
No. The main one that boils my blood is a home. So normally if you live in a home and you sell your home that you've always lived in, you haven't rented it, it's all tax-free. But they changed the rules a couple of years ago that if you move overseas and you sell your home, you've lost proportionately that main residence exemption.
Doesn't sound fair, does it?
They've put some grandfathering in there, but it's still a terrible thing. The other big thing that is people make an error is if they own shares. So when you go overseas and you sell them, you have to tell the ATO that you've sold those shares, even if you're not in Australia.
Really?
Yeah. Now, how would they find out? Well, you finally come back to Australia. You did tax returns that had share dividends. You're no longer getting share dividends. This $150 million a year they're spending on IT does some data matching and says 2 years ago, when you're an Australian tax resident, you had dividends from ABC Proprietary Limited that are no longer there. Please explain. It's getting very, very difficult for people who don't understand their obligations to maybe do the wrong thing, even if it's inadvertently.
Okay, well, expats should be watching out and getting correct advice. Maybe lastly, we'll finish with something that seems to be more and more prevalent at the moment, side hustles or the gig economy, which has skyrocketed over the last years. What's the taxman think about that?
That is income that you pay tax on. So if you're driving an Uber, if you're renting out the family home or a room, if you're doing a little bit of, put the IKEA furniture together for somebody, that's all income and you've got to declare it. Now, depending on what you're doing, there may be some expenses you can claim, but you've got to declare that. And the other thing is if that income that you're getting is over $75,000 a year, you've got to register for GST. And then you've got to pay GST. You've got to do your BAS statements.
So you're really a business, aren't you?
You are a business.
And so you need your business number, keep the correct records, lodge a different type of tax return, register for GST and BAS statements. People sometimes don't realise that.
That's it. So even if you're not at that GST level and you've got a side hustle, I think is a common term used, you might be making 10, 20, 30,000 a year where you don't register for GST, but that is business income you're generating. And as such, you've got to declare it. And in Australia, your tax return is self-assessed. That means it's your obligation to tell the ATO, not their job to go and find out.
Yeah.
That's why the penalties are so high, because they're saying you should have known and you should have told me.
Mm. Well, I guess looking at all this, it's clear the ATO is now going to watch us all more carefully. And if you've done nothing wrong, you've got nothing to worry about. The trouble is, you can do things wrong without the intention even, because you don't understand what's involved.
Or without knowing you've done something wrong.
Yes. So I think that's one of the reasons we recommend all property investors and small business people get a proficient team of wealth experts in their corner. And I know your team at Metropole Wealth Advisory provide strategic wealth advice for property investors, for their family, particularly for professionals and business owners. And some people would say, I'm not at that level yet, Ken. Who is it that you can help?
Look, I think professionals, people in their own business, people with investment properties, or people even buying their first investment property, I think you've got to do it right, and you've got to do it right the first time. Because the exit costs out of trying to unravel something in property is quite large. Capital gains tax or income tax, there's certainly a stamp duty, so quite horrendous. For people doing developments, that's just another complication. Unless people that our listeners are using are proficient and understanding with a lot of experience in development projects, then it's not necessarily correct. And it's just funny. Even today, I was speaking to a new client. They had this elaborate structure, and when I asked them what was their end game, because we always ask people, whatever you do, you got to do it with the end in mind. That structure did not achieve any of their end requirements. It could have been done much simpler and therefore at a much lower cost with better tax outcomes. So again, it's ask.
Well, you deserve your own private wealth advisor. You deserve having somebody like Ken on your side to help you create a strategic wealth plan, and especially if you're a property investor. And I think you've already heard, if you're an expat or if you're a migrant who's just wanting here to start your new life and understand how to set yourself up correctly, go to metropole.com.au and find out about Ken's range of services, and just leave your details and have a chat with Ken. Ken, thank you very much for this. We have these chats regularly, monthly. I know that the last one on estate planning was very, very popular, huge number of downloads. So if you haven't heard Ken's advice in previous podcasts and you're a new listener to this, just go wherever you're listening to this podcast app and go back. And if you see Ken's name attached to one of the podcasts, I think you should go and listen to it. Thanks for your time, Ken.
Thank you, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I want to show you 11 valuable insights into how to fail at life. Hey, what's Michael talking about? Well, you wait on and you'll hear, because I found, generally speaking, people live their lives in one of two ways, either happily and successfully or miserably with loads of regrets about what could have happened. Those who are happy and successful don't necessarily have a more blessed or lucky life than the other mob. In fact, they could live in the same type of house, have the same family situation, have the same job, have the same assets. So what sets these two polar opposite ways of living apart? And personally, I think it's got a lot to do with how we choose to live our life, with the things that happen to us as we go along the way. You see, let's take mistakes and failures. While perceived mistakes and failures knock some people down, it knocks them down for a long time. Others learn from them. They get right back up. They just do things a bit differently according to the lessons they've learned. Now, I remember one of my mentors, Jim Rohn, the late Jim Rohn, once said, "It's just too bad that failures don't give seminars, because understanding why some people never seem to get anywhere in terms of happiness and success, no matter how hard they try, that could be a very valuable learning tool." So in today's mentorship session, rather than giving you the standard 10 tips on how to be successful or something like that, I'm going to show you 10 things you should never do if you want a rewarding life. Or maybe we should actually look at it differently, tips that you should do if you want to fail. So the number one thing you should do if you want to fail is just cruise. Go along day by day. I mean, who needs to set goals? Why don't you just wait and see what happens, what takes your fancy when you wake up and stumble along through each day? If you want to fail in life, the next thing you should do is stay in your comfort zone. Think about it. To grow as a human being requires work, and more often than not, it requires embracing the unknown. I don't want to stress. Instead, just remain safely in your own little cosy zone. As we're looking at things you should be doing if you want to fail in life, one of them is just believe in nothing. Cynicism requires a lot less work than believing in something, because if you do, then you might actually have to do something about it. So why don't you just go around pointing out flaws in everything and always looking for what could go wrong? If you want to fail in life, talk a lot. I mean, why bother listening to what other people have got to say? After all, you know it all. So make sure you tell your story and you tell it often, no matter how much it bores other people. The next tip on how to fail at life is don't risk failure. The answer is don't try, because we all know the best way to avoid rejection and pain is not to do anything. Of course, you should also take care of number one. Maintaining friendships and relationships, that takes time and energy, not to mention the potential sacrifices you might be forced to make and the sheer inconvenience of it all. Why not just look after yourself? That's all that matters. Again, surefire way to fail in life is never take the blame. Apologising or being responsible for your own actions, oh look, that's so yesterday. Just look at all the litigation that goes on in our modern world as people seek to find somebody else for the fault that's going on in their life. Remember, it's always somebody else's problem, not yours, isn't it? Another way to fail in life is sleep a lot. Make sure that you sleep a lot. Sure, there are only so many hours in the day, but why spend them accomplishing things and progressing when you could be getting a bit of sleep? Another way, of course, is always defend your point of view. Remember, that's the only one that counts. If somebody disagrees with you, don't let it go unchallenged. Make as much noise as you can until they give up on the debate. Another way, of course, is to stay guarded. Trust can easily lead to hurt, to heartache. So keep your walls up. Don't let anyone in. Never, ever. Of course, the last message I'm going to give you about how to fail in life is always expect the worst. If you walk around expecting something good to happen, chances are you're just going to get disappointed anyway, aren't you? So don't risk that self-doubt and angst that can accompany unmet expectations. Surrender instead to the philosophy that life sucks. So in conclusion, if you want to live a self-fulfilling prophecy of life full of disappointment and despair, and ultimately be a loser, just follow these 11 ideas I've just given you. On the other hand, if you want happiness and success, perhaps see if you can have a long conversation with somebody who's never found success and learn more about what not to do. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?